Hey everyone, it's Steph Pastore. Thanks for joining me today. For today's video, I wanted to talk about the ways to not mess up your pre-approval on your loan during the home buying process. So there's a few things that buyers actually seem to be pretty surprised about, and I think that lenders don't always give buyers a clear-cut list of what you can and can't do from, the moment you've got your pre-approval all the way through house hunting up until closing day, until the house has closed. So here's sort of the list of what you can and can't do. So first thing you cannot do is quit your job, change your job, or change your pay structure, meaning you can't go from you can't switch to part-time and be making less money. You can't quit your job, change jobs, because typically the lender needs at least a set amount of paycheck stubs. So at a minimum, your loan will get delayed. And then the worst case scenario is that it would be canceled and you no longer qualify, because what the lender is looking for is your debt to income ratio. And they're looking to for stability to make sure it doesn't change. So you got to keep your job, the job you got pre-approved for, you got to keep it for the 30 or 60 days until we get you into your house, until that loan closes and the house is yours. Next thing is opening new lines of credit. This happens all the time. People get so excited, they're buying a house, and so they go out and get a new car, or they trade in their car and take on a new lease, or they go to Home Depot or Lowe's to get all the appliances for the new house. And, Home Depot has a sale. Well, you'll get 15% off if you open a new store credit card. And so it sounds like a great deal, but any of that, any new credit checks on your credit report, the lender's going to pull, and that is going to potentially cancel your loan and make it fall apart. You can't open any new lines of credit because it changes the whole process. It changes your debt to income ratio. And that pre-approval that you have is no longer valid because the paperwork needs to be redone. So don't go open a new credit card. Wait until closing. Don't get a new car. Everything basically has to essentially just stay the same during the process. Another thing is keep paying your bills. Sometimes, depending on your loan type and what your debt to income ratio is, your lender is going to recommend some of your credit cards get paid off beforehand or after. Or from closing, part of your funds is going to pay off. You have to make certain, though, any credit card or bill or current mortgage that you have to keep paying it. You can't have any new late fees pop up on your credit score. So anything you're paying, keep paying until that account has been closed and you have closed on your new house. Another really common thing, a lot of buyers, especially first-time home buyers or younger people who are getting some financial help from maybe their parents or from a family member, they get a gift. I would say 99% of the time, getting a gift is totally fine as part of your down payment costs, or for your down payment or your closing costs. I mean to say, you just have to have that conversation with your lender. You have to let them know where all the money is coming from, and you have to make sure you're getting the proper documentation. Usually it's a letter from that person that makes it clear that it is a gift and not a loan. That's something I think some people maybe don't understand. Oh, my parents are going to loan me, $50,000 to put on the house, and I'm going to pay them back. Well, then that's another loan. So that actually would be counted in your debt to income ratio, because now it's a balance to pay off. So that's totally different than a gift. So just making sure if you have any, if you're getting any cash gifts for your house, that you have the proper documentation for that to your lender. And then finally, no random deposits or withdrawals that are very large or that are unusual for your banking history. You're allowed to spend your cash and the money you have. You are allowed to, keep using the credit cards that you already have within a certain reason. Now, if you're really close, your lenders had that conversation with you that you are, at that max of their debt to income ratio requirements, then you really want to be careful not to make your credit card balances any larger. But your standard payments and your standard day-to-day living expenses that are all the same are fine. But if a lender, 3 days before closing sees there's been a sudden $7,000 cash withdrawal, or, a $5,000 cash deposit, they're going to be on the phone and they're going to be holding up the closing of the loan until you can get them the proper documentation and they can make sure there's nothing sort of suspect with it. So all in all, the biggest takeaway that I want you to realize is once you get that pre-approval process and you're ready to buy a house, you got to just hit pause on everything else as far as financials go. Everything needs to stay the same. Maintaining the status quo is the most important thing you can do until the day you get the keys to the house and it is recorded and it's in your name. So I just thought some of those helpful tips might be useful to you. If you have any more questions about buying or selling, always feel free to reach out. I hope you all are having a good week. Talk to you later. Bye.